Hello, everyone. Welcome to this Off the Cuff. Very pleased to have back with us Wolf Richter. Wolf, welcome back to the program here on September 2nd, 2020.
Thanks for having me back, Chris.
All right. So crazy day in the markets. I've mentioned this a couple of times in other events I've been doing today. That whole crazy idea that the market cap of Apple now surpasses that of the entire productive company public listed output of an island nation of 60 million people, AKA the UK. That's pretty expensive, don't you think? Would you rather, if you were given the choice right now, would you rather own 100% of all the listed companies in the UK or Apple? What would you pick?
Well, I don't know that I would pick Apple at this price. There are probably worse candidates out there. I mean, like Tesla, Apple is worth what, four and a half times what Tesla is worth, and Tesla has hadn't any revenue growth in the last 12 months. It's in a stagnating to declining industry, the auto industry. There's a lot of good candidates out there that I really don't want to own.
so many good candidates you don't want to own. But we're in crazy bubble time. So let's walk through what the Fed's official stance on bubbles has been through my adult lifetime. First, there is no bubble and you can't see them in advance anyway. That's what they would say, right?
That's right. And that's what they have said consistently.
Yeah.
You can't see bubbles. Nobody can see bubbles.
Really? I think I can.
I can too.
So that's step one. Nobody can see them. Step two, I think they learned because Alan Greenspan used the words irrational exuberance once, and that just about tanked the market right there for a little while. So they don't do that anymore. So now they're just mum on the whole thing. I haven't heard a single Fed person mention one thing about excessive valuations here. Not one. Have you?
Correct. I mean, they're saying that they accomplished their goals in propping up the credit markets, and they did agree that they meant to prop up the credit markets, and that they're now saying, we did succeed in doing that, and propping up the credit markets obviously meant inflating the bond markets, bringing up the valuations of junk bonds and mortgage-backed securities and commercial mortgage-backed securities and all this other stuff that was blowing up. So they have created that bubble, and that was part of their plan. And they just don't call it bubble. They just, fixed an implosion
by stabilizing it in a shape that looks like this, right? It's and then step three, the bubbles always blow up. Why do bubbles blow up? What's wrong with a bubble?
Well, I mean, obviously, if they didn't blow up, there wouldn't be anything wrong with them. I mean, everybody loves a bubble on the way up, and if there's no hangover, then there wouldn't be a real problem. And you have to think about what bubbles are doing there. State and local governments are getting taxes out of housing bubbles. They're getting capital gains taxes. California is very dependent on capital gains taxes. So there's a huge interest in local and state governments to maintain those bubbles. The whole financial industry has a huge interest in maintaining them. Companies wanting to fund their money-losing operations. I mean, just look at Tesla. The bubble allowed it to issue another $5 billion in shares, so that it won't run out of money. Yeah, so there's not a lot of people that don't like bubbles. It's just when they blow up, everybody comes around wailing, and so that's really the problem. They do blow up, and then suddenly that's a reason not to have bubbles. Because the damage is huge when bubbles blow up. During the financial crisis, it did an enormous amount of damage when those bubbles blew up. Now we had another bubble blow up, and the Fed spent $3 trillion trying to reflate that bubble. And we've got 28 million people now still on unemployment compensation. So, I mean, the damage is just huge when these things blow up.
Yeah. So let's take the the poster child there for it. Tesla, in many ways, I'm looking at Tesla as the bellwether, the canary in this particular story, because it's just so extreme at this stage. So first up, remember, all bubbles need two things, and that's it. You need ample credit, and you need a story. So the story around, you just described the credit markets, and they were repaired by the Fed. So there's like money everywhere, no matter what it's flowing into. But the story around Tesla is really interesting, because I hear people talk about, they say it's not really a car company, it's a data company. You don't understand, they're going to mine asteroids. The guy's going to put chips in your brain or whatever. There's like some story around all the magic things that's going to happen. But day after day, I look at my Twitter feed, and people post pictures of like their Teslas with like bolts missing and paint jobs undone and wheels falling off. So they have quality issues that are pretty legendary. And then I don't know if you've noticed, but both the VW and the Mercedes-Benz E models, they look fantastic, right? Great trim, finished paint. I'm pretty sure the wheels won't fall off, or the bumpers, all that. So I actually see Tesla as a company that doesn't have an insurmountable lead in cars and automotives, or even the data that helps determine self-driving. I see them as another company in a space that's increasingly crowded, where it's up against giants who actually know how to crush the manufacturing thing. Like, they do it really well. So when I look at the Tesla sales numbers out of Europe, once the Volkswagen EV car came on, pretty much crushed it. It's now I would consider them being a fight for their life. So that's just some of the data. And then they issue 5 billion new shares. So when you say something like that, I just want people to be aware that when a company issues a share, they have a market maker, say Goldman Sachs, they're selling those. So somebody on the other side of that's hitting the buy button, and cash is flowing out of their bank account and coming in for the issuance of those shares, routes through Goldman Sachs for a cut. But ultimately, that's $5 billion of money that went from point A to point B. It didn't just appear in the markets, right? So that's just an astonishing thing to me, that we could be seeing a company with the financial prospects that Tesla has, not having any difficulty raising $5 billion.
And it's particularly interesting what you just said, because we are in a 2-decade phase. We're on in terms of unit sales, not in dollar sales, but unit sales, the auto industry in the United States has declined. And with some big periods of growth and some big periods of collapses in between, but we're now back where auto sales used to be in the 1990s. And in other mature markets in Europe and elsewhere, it's the same thing. And people are driving their cars longer, they're buying fewer cars, cars last a lot longer. I mean, you have all these things coming together. There's some shift to mass transit and different. And now we've got working from home, so there's even less use for cars to commute. And so this whole industry has been caught in this very tough situation where the only revenue increases is through price increases. You have to increase the sales prices of each unit. So everybody's going up scale. So you get these $85,000 high-end pickup trucks and those sort of things. And even the entry-level cars are now fairly expensive. And so that's been the growth model. It's just selling more expensive cars. The unit sales have been flat or down for 2 decades. So this is the industry Tesla has chosen to be in. And at first it was great because it was the only major EV maker. And I credit Musk tremendously for putting EVs on the market and for making them cool. And GM has had an EV in the 90s, and it couldn't make it go because the battery technology wasn't up to snuff. Now, Musk gets his batteries from Panasonic and some other suppliers. They're much better now than they used to be. So they're working now. The EVs are actually functional and usable. And Musk has written this thing up, has created actually this whole industry. And now automakers are taking him seriously. And like you said, there are real automakers out there. And Tesla has less than 1% of global market share in the auto industry. So these big ones are now all making EVs. And they're bringing them to market. And in different countries. In Germany, Tesla is getting crushed by the German EV makers, even by Renault and French makers. You know, that they're all coming out with their EVs, and yeah, they're not cool. You know, many of them are just standard cars that you go to work with. And that's what most people buy. Not many people can afford a $100,000 vehicle. So the most common vehicles that are sold are at the low end. And EVs are much cheaper to produce than regular cars. The battery's expensive, but once you get over that, EVs are cheaper and easier to produce. And so every automaker has now gotten on that, and they're coming out with model after model after model, below the price point and above the price point where Tesla is, and right at the price point. So they're coming out with SUVs, they're coming out with pickups, they're coming out with economy cars and everything, and sports sedans. And so now it's quality. It's quality of manufacturing that decides who wins that battle. It's quality of service. It's all kinds of things that these automakers have dealt with for decades, and that Tesla hasn't had to deal with yet. But now they will have to. So they will have competitions from the real automakers. And, Tesla has got a great name. It's got an enormously popular brand, has a fantastic name, and it has some real advantages. They don't really have to spend money on advertising yet, but they did have to cut their prices in the United States and elsewhere this year because demand has fallen off a cliff. And just like other automakers, other automakers have to discount. So Tesla is now in the ballpark where it has to cut prices to sell cars. That's where the other automakers were. It's exactly the same level. So now it's hand-to-hand combat, and we'll see how Tesla works out. But the valuations of automakers is low because of the mature industry and the tough market and the conditions in that market and the reluctance of consumers around the world to buy cars and all these issues. Yeah, so Tesla is right in there, and instead of having a stock price of that gives it a value of 600 billion, it would more appropriately have a stock price that gives it a value of, I don't know, 20 billion, 30 billion, something like that. And Toyota is #1 automaker in the world, the most profitable automaker in the world, possibly the best run automaker in the world, and it's got a valuation of around 200 billion. So that's what, and Tesla doesn't even measure up. I mean, Tesla is not even a rounding error in Toyota sales figures, and the stock valuation just doesn't make sense. It's just completely nonsense.
Well, you just described if it has an enterprise value of 10 to 20 billion. I have to do this in my head. If it's 600 billion, that would be 96 to 98% of its value would have to go away. That would put it at about $4 a share right now.
Yeah, I would round it off to 90% or 80% down, and then it would be, if it's profitable, actually, it would have to be profitable. If it can't make any money, it would be worth a lot less.
Yeah. So, and yet here we are, right? So I've been through bubbles before, and I always spot them early. I always find them disappointing. I find them disappointing because the quality of the commentary just goes out the window. But this one, to the credit, it went out the window pretty quick this time with like commentators and CNBC going, yeah, it's not just nuts. It's now they're trying to describe how stupid this is, right? But it's happening. So here we are. I think this, I think this is going to, when this breaks, it's going to be by far the most destructive bubble ever. The Fed seems to think they can control it now. They've got new tools in their toolbox. They don't hesitate to do stuff. There'll be hues and cries to buy stocks if they ever dared to correct by what do you think the new margin of like 5% would be, like a terrorizing moment for the Fed, or whatever the number is. But the idea is that the Fed can now control all pricing in all markets. It's not a bad hypothesis because they've been able to do it so far. I just don't think they can do it forever. And I don't think it's a good idea. And I don't think we should want it, because for every consequence, there's an unintended consequence, right? And so the Fed would just say, they're trying like crazy to say, we're not responsible for the wealth gap, clearly it's a consequence of all their behaviors. So to me, I just see unintended and maybe intended consequences are piling up, and maybe it's showing up in protests, the unrest that we're seeing, because some of that's rooted in a sense of unfairness, not all of it, but some of it. So I just think that this is probably Jay Powell is going to go down as, and I hate to say this because he's got such strong competition, but possibly the most ignorant, misguided Fed chairman ever.
That could very well be. He, in the last press conference, he was asked, the Zoom meeting, and he was asked about the wealth inequality that the Fed has, whether the Fed feels responsible for that. So, I mean, there's a Bloomberg reporter that asked him. So there is no actual blowback, even if it's mild and polite, coming from some of the media outlets about this issue. And he brushed it off, and he blamed other issues for that, including globalization and then the power concentrated in some big companies, and but all that. And then he said, well, the Fed policy has nothing to do with it. And I agree, globalization is it has something to do with wealth inequality, and the concentration of power among a few large companies has something to do with it. I mean, he was right about that, but brushing off the Fed's share of that problem, that I think is pretty. And I don't think it's ignorant. I think he knows. These people are not stupid. Mm-hmm. I think he knows that, but he just can't admit it. He can't say, look, the Fed is creating wealth inequality, and we're doing it because we want to enrich the wealthy because that's our clientele, and we want to bail them out, and then that will help the overall economy. And they did that. They had the wealth effect, and Ben Bernanke explained it that way. The new Fed doesn't use the phrase wealth effect anymore. The old Fed did, and Janet Yellen wrote about it when she was head of the San Francisco Fed years ago. And there's actually papers out there about the positive outcomes of the wealth effect, and that the Fed has to make the wealthy wealthier, and that will pull out the overall economy. And so that phrase is no longer used, and it's a very delicate thing now. And but I think they're all aware of what they're doing, and it's purposeful. And but you cannot admit to it that what the Fed has done is contribute a huge amount to the now record-setting wealth inequality that we have in this country, with so many people homeless and so many people on unemployment insurance, and the wealthiest being wealthier than ever before, and thanks to the Fed. And that's not good for the economy overall. And there's lots of economists that have now pointed that out. So I think there is some pressure on the Fed to not overdo this. And the Fed may actually, and so far its asset purchases have indicated that it's sort of backing off. They're really, for the last 8 weeks, its assets have just ticked down a little bit. They haven't gone up. And so I seem to think that I don't want to blow up the whole country. There's a sort of a reluctance to do that, I think.
Well, I know it's globalization. That's just like, how do you put your finger on that? But to me, it's pretty simple. The wealthiest people own financial assets. The Fed targeted financial assets going up in price. That's pretty straightforward. It's not really, it doesn't take a lot to connect those two dots, but I can make it even more direct. We're up to roughly 30% of all households in some form of forbearance or for other reasons aren't really complete on their mortgage payments. So you would imagine that a lot of the mortgage-backed securities that are linked to those non-payments would be down in price, but they're not. The Fed's been out there sopping up so many mortgage-backed securities that they're basically paying over par on these things. There's not a universe that I know of besides the one we're currently in where mortgage-backed securities backed by a 30% non-payment, partial or complete schedule, that those would be worth more. Those would be worth 103 instead of, say, 82 or something like that. So the Fed is buying those from the current holders, who I'm going to surmise might be some of the wealthier individuals, entities, and corporations out there. They're buying them from them and directly giving them more than they're worth. That's a direct payment schedule.
And it's interesting what you're saying, because it's in essence, these mortgage-backed securities the Fed is buying are taxpayer guaranteed. And so the taxpayer is on the hook for the mortgage defaults. The losses would be taken by the taxpayer, not by the Fed. And by the the investors that own those would also be made whole, essentially. Now, there's another group of mortgage-backed securities out there that are not backed by the taxpayer, but the Fed doesn't buy those. So so this is a whole complex dynamics that we're now facing here with with the taxpayer on the hook for those mortgage-backed securities, with the Fed buying them to drive up the price, and at the same time we've got these mortgages in forbearance. So this whole flow of cash that goes from the homeowner to the bank or the servicer of the mortgage-backed securities, and then to the investors, that flow has been interrupted. And now that it's supposed to be over, but now they're talking about extensions, and the forbearance has already been extended for a year. So I don't know that they can figure out how to ever get out of this. At the same time, we've got the Fed, and it's creating one bubble after another here, and it doesn't even allow the system to clean itself out. So we got this financial asset bubble. At the same time, we've got this huge problem where all these structured securities have the payment flow interrupted, and it's an enormous mess, and we're surrounded by bubbles. It's just fascinating.
Well, so how do you decide what you're going to write about? It's such a target-rich environment. Like, do you throw darts, or do you prioritize, or because my goodness, pick a sector. There's a story.
Yeah, and I don't write that much about bubbles because it's kind of the same story, So I did, Tesla is one of my favorites because I cover the car business and I cover the regular automakers and I cover Teslas. And I'm a fan of EVs. I like the technology. I think it's great, and I'm glad they're here. And I like the way the Teslas look. They have an elegant design. But like as you pointed out, we've got all the quality issues and all this other stuff that the Tesla has. What I'm really writing about is Tesla's share price, and the financial part of it, and how the whole system is set up to create this phenomenon. I call it the Tesla stock. I call it a supernatural phenomenon because it's no longer grounded in any kind of reality. And so I occasionally do that, but I write about the other car companies too, and mostly really, and their real life problems and the issues they're facing. And I cover all kinds of stuff that are unrelated to bubbles, but having to do with the real economy and the real issues that companies and consumers, borrowers, the like have to deal with.
Well, how about one of my favorites? I was just talking with Art Berman. I'm sure you're familiar with him, the other day, and he's convinced that barring some miracle, but he doesn't think there's a miracle that's possible of this magnitude, that we're on track in the United States to drop down to I'll just make it a single number, to just under 6 million barrels a day by June of 2021 of oil production. It's just that devastating what's happened out there. I know you've been following that space pretty closely. A lot of wipeouts going on there too, because there was a story there, but it's not quite as exciting as a Neuralink asteroid mining pig or whatever's going on with the other story, right? But have you followed that of late and have a sense of the financial destruction that's going on there?
Yeah, that's the fracking business in the United States needs a very high oil price and oil and gas price. So the gas price collapsed first, it was 10 years ago, in natural gas. And when fracking started taking off for natural gas, and that's where it made its first big impact on a national scale. And as a consequence, the United States became the largest natural gas producer in the world, like in 2014 or 15 or something like that, from being up from having to import natural gas, we're now exporting natural gas, and we're exporting it via pipeline to Mexico and via LNG to the rest of the world. And but all of this has been a money-losing business from day one, because fracking is expensive. It eats up cash, and it requires a lot of cash. So we've had one bankruptcy after another, including Chesapeake, which used to be the largest natural gas driller, or the second largest after Exxon in the United States, and the largest fracking operator in terms of natural gas. We've had hundreds of bankruptcies in the shale oil and gas space, and also now in the offshore space, and both drilling and oil field services. There have been hundreds of billions of dollars destroyed in this operation over the past 10 years or so. That's investor money. Now, there's an old saying in the oil and gas business: don't ever drill with your own money. You know, it's other people's money you drill with, and you make the profits. And when it doesn't work out, you know, the investors take the losses. And that's exactly how that happened. And I've been through oil busts before, having lived in Texas and Oklahoma for decades, and especially in the 1980s when we went through that thing. And in Tulsa, where I was living at that time in the 1980s, you know, the Tulsa used to be called the oil capital of the world. And then the oil business shut down there, and all the headquarters were moved to Houston, and Tulsa went into a multi-decade depression, and I'm not sure it ever recovered from it. And that was before fracking. But I know what the damage is in these areas where oil and gas is being produced, and where these companies are headquartered. I mean, that it's well-paid jobs that just, and hundreds of thousands of them, that just disappear from one day to the next. And these people that used to make $100,000 or $150,000 a year, they now can't find a job at a McDonald's. And that is a large number of people. And some of them are specialists, some of them are roughnecks, you know, some of them are IT workers. And it is devastating. It's devastating to the local economies. And it's broad spread. It's trucking operators, it's suppliers, it's manufacturers, companies that fabricate some of the specialty equipment, manufacturing. So it has a huge impact in those areas, and it spreads out. So there's a national impact now, but in the local areas, it's devastating. And I really feel for those areas. And if there were a single industry town, like you have some of those towns in West Texas, you know, their industry is oil and gas drilling, and that goes to heck. I mean, that town's economy essentially comes to a standstill. And that is very, very tough. And I feel for these people. At the same time, the overall industry was governed by the story that you're saying, that the only thing that matters is production. Profits will somehow come later. We just have to ramp up production. And they did. And the United States became the largest oil producer then, after becoming the largest oil and gas producer. And so they created this huge, huge surge of production that no other country's ever done in such a short time. And then the price of oil and gas collapsed, and to levels where, or even the cheapest drill sites can't make any money. And unless oil and gas prices come up, I mean, these companies are going to shut down operations. And I don't know whether this is at 6 million barrels per day or whatever the level is. You know, it's going to be at some level where there aren't hardly any survivors in the United States, and at that point prices will rise. So that's the industries, and then suddenly we'll get a price explosion like we've had in the past, and then of course then fracking will ramp up again, and it takes about 2 or 3 months to ramp up the operations, and within a fairly short amount of time you'll have overproduction again, and we're right back. You know, so as soon as money flows into the sector, they'll ramp up production. When money leaves the sector, they'll shut down. Right now they're shutting down, and with tragic consequences for the local economies. But it's devastating what's happening to that industry. But the industry brought it on itself. Yeah, it's that whole story, and it was fabricated. It was a lie. It never worked out. The production numbers were exaggerated, and all this stuff is coming out in bankruptcy court now. I mean, these oil fields that used to be worth billions of dollars are now worth cents on the dollar, and it's just the whole thing, you know. that's one of those stories that fell apart.
Yeah, it was. Well, that was a bubble of its own. And I think the Fed has a role in that too, because if capital wasn't so starved for yield, as they say, chasing yield, that I don't think so much would have flowed into that space. And then you might have had more rigor, a little more discipline in there, because it was a very undisciplined space, right? And for years and years, the CEOs were able to get away with that one story, which was, oh, but look at our production numbers. It's like, yeah, but where are your profits? Ultimately, where are the profits? I don't think that industry is profitable anywhere near what they claim to be profitable at. I think that a lot of times, there's a lot of smoke and mirrors in that business. But when they say our break even is $30 a barrel, what they really mean to say is, if all we did was have to lift that oil out of the ground, and that's all we had to do, $30 is the number. And you're like, well, how do you pay your CEO? And how are you managing your company jet, and how are you paying all that debt back and all that other stuff, right? So when you do the all-in sustaining cost of production, the AISC, you get a number that usually I think is about twice as high as their stated, break-even numbers. At least that's how it's looked to me from the outside, because every year, you get your Diamondback Energies and whatever, these companies say $30 a barrel, 40, that's our number. But then we had 50, and you look at their earnings statements and you're like, there's no money here. You're still burning cash. I don't get it. And it's been hard to put it together from anything other than a standpoint of saying, I think oil prices have to be twice as high as they are right now for these companies to even roughly get by.
One thing we've learned over the last many years in this industry is that you can't trust the numbers they're putting out. And it doesn't matter what it is, you just can't trust the numbers. And the projections, they're estimates, and they're estimates that favor the story. And investors gobble that stuff up. And then especially in an environment, like you said, where the Fed represses interest rates, it takes out all the discipline. So now there's no more discipline. Everybody's chasing yield. And instead of scrutinizing every little thing these companies are putting out, investors are jumping blindly into it. And that's what's happening. I think you make a lot more educated and sophisticated decisions when interest rates are high. When times are tough and interest rates are high, when the cost of capital is a real issue, you decide where you can put your money, and you're looking very careful at everything. And that's when you make good deals, and that's when the economy starts to function, because you don't fund deals that are money losing operations. You fund deals that work and that produce something. And on the other hand, I'm kind of glad that investors wasted $200, $300, $400 billion of their money to give us cheap gasoline and cheap natural gas. Yeah. So, it wasn't my money. So, I'm glad it wasn't the government that did that. I'm glad it was private money. And so if it wasn't your money, we got subsidized by these investors.
Well, here's where I'm going with this. So let's imagine Art's right. It's June of 2021. United States is now producing half or less of what it was producing at its peak. His point was that just because, he said, even if there was no friction in the systems, Schlumberger hadn't laid off 21,000 critical people, they were all still just waiting to get back on the frac crews. He said, with no friction, and investors don't have to be lured back to the table, they're just all piling back in. He said, if you said, we want to reverse this right now and we want to throw drill rigs at it, super frictionless, the industry's been nationalized, the Fed's buying the equipment. He said, it's still going to take you a year to turn that whole thing around, because it might be a month to spud and drill a well out, but by the time it's fully completed and it's brought online and all the tests have been performed, it's about a year. So he said, no matter what, even in a frictionless environment, that's his call for a 6 million barrel per day number. So who knows what it is, but it's something a lot less than it used to be. But I think one way or the other, either we learn to live with COVID, it's just sort of endemic, or we figure out why some people are a little bit more susceptible or a lot more than others who seem to be not susceptible, or a vaccine comes along. Whatever the story is, we get past it. And that's where I think we have element one, a giant wall of Fed money, which they know how to put in, but they're really not good at taking out, because it might cause the markets to become dysfunctional, which means they go down. So they're not going to do that. They're going to keep the money out there. And then the economy actually comes back. But the United States now isn't producing anywhere close to the oil it needs to run that economy. I'm making a case here, well, for a pretty big price explosion that would have to happen because we're going to have to compete on the open market for that.
Yeah, you're right, and we already see the price explosion in other commodities that we're using a lot of, like lumber and different things. So
Lumber.
yeah, so and this stuff initially is just a commodity, but higher lumber prices mean higher construction costs, which means higher house prices down the road. Higher energy prices, higher oil prices mean higher gasoline prices, but it also impacts the transportation sector, and oil is used in plastics and different things. So yeah, fertilizer. So you get these price increases that filter into other products, and I definitely can see a solid case for a big bout of inflation, and the Fed's going to look at it and say, well, we're going to let that run over, and as they have already said, so I think that's a real possibility.
Do you think we could get runaway inflation? Because I know there was this major policy shift where the Fed's saying we're gonna do away with our inflation targeting, or rather, we're gonna say, geez, since it was so low for so long, it wouldn't hurt us if it ran a little hot. The difference between running a little hot and running away from you is not always an easily defined, sharp, crisp line in the sand. So what do you think the chances are of Fed being slow to the punch and being tolerant of higher inflation and that getting away from them?
Yeah, I think they're going to be slow to the punch, as you said. In terms of getting away, so one thing we have to look at is if the Fed looks at core PCE. And core PCE, this inflation indicator, runs roughly half a percentage point to a percentage point lower than core CPI. And so when the Fed talks about 2%, it talks about 2% core PCE inflation, which is 2.5% to 3% CPI. So already we're at fairly high inflation rates, just in the middle of their average that they're looking for. Now, when they're letting it run over to 4% core PCE, that's still the summer, but now we may be looking at 5% CPI. And in my book, that's already very high. And now you're talking about some real damage all around, and unless wages can keep up with which they haven't in the past, and so you're talking about the purchasing power of labor declining by 5% or maybe a little less if the wages do rise. So that will hit the economy. So then there's starting to be some big issues with that. If the Fed at this point doesn't step in and it goes up to 6 or 7% CPI, I think there will be some major damage to the economy, and the Fed will then crack down, and that will cause even bigger issues. And we've been through this program before, so I don't think they will let this get away. I don't think they want this to get away from them. I think they will eventually step in, and but until they step in, they'll delay that. They'll let it run hot, and there is a chance that it's very difficult to bring inflation down when it's running away. You need to act pretty strongly to get it like a Volcker kind of thing. And you need to act pretty strongly to put down inflation. And so that's a scenario that I really don't want to see.
Mm-hmm. Mm-hmm. Well, speaking of scenarios you really don't want to see, do you ever feel like you're living in a dystopian movie? I saw the pictures you posted of that ghost town you live in. What's it called? Oh, San Francisco, right? Was that weird, creepy I mean, is it weird and creepy to see these formerly populated areas depopulated like that?
It is very creepy. I mean, it is bizarre when you walk through a financial district like San Francisco's during rush hour, and there's hardly any pedestrians out there. There's a few cars, parking spaces available, parking garages empty, stores closed, a few vendors are open, but they're not doing any business. It is creepy, and thank goodness, San Francisco is alive. So when you go to other parts of the city, there's people milling around doing stuff like along the shore, along the beaches. It's crowded there. People are out there. Yeah, it's not like you're living by yourself in that city, but but in the financial district, it is dead, and that is, that's why I took the pictures. I wanted to document it. Because you walk through that, it's like, holy crap! This is something I'd never expected to see in my life, and there it is. It's like one of those dystopian movies.
Yeah, is that I've been talking a lot about this where, and you've seen the articles on Zero Hedge, and they're on other places, but cities are sort of emptying out. Is San Francisco part of that? And is this structural? I mean, we're Zooming right now. Are all these Google employees and, Salesforce employees, are they all going to Zoom in? And does that fundamentally change the character of the city?
Yeah, so definitely. And I had, Google is unavoidable for me. And so I had to deal with a Google guy, and he used to live in Silicon Valley somewhere. And so we had a Zoom conversation, and he was back in St. Louis, Missouri, and working from home there. He'd left the Bay Area, and you see this a lot. There's a lot of people are leaving. They don't have to live there anymore, so they're gone. So you do have this exodus. There's always some exodus from these expensive places, but there's also an influx of new people coming either from the United States or from outside of the country. And that influx has essentially stopped. And so now you have the outflow without any of the inflow, and the outflow is probably larger than it used to be. And, you see that. I mean, traffic and this whole thing. San Francisco has a lot of high-tech jobs where working at home is just fine. So, I mean, you have some of that, but a lot of these people that don't have to live here decide not to live here. And we have a sort around the country, there is kind of a shortage of housing inventory, as they call it. In San Francisco, we had a record surge in housing coming on the market in the last 2 months. And suddenly everybody's trying to sell their condo and the house. And it's just, boom, right there is all the inventory we haven't seen in decades, or ever. And so you see people are trying to sell, people are leaving the apartments, so there are a lot of vacancies. Rents have come down 20% from the peak so far. They've dropped 5% just from July to August, just in 1 month, 5%. That's a huge move for rents. These are average asking rents. So, or median asking rents. So this stuff is happening, and I live here, and I kind of enjoy the end of all the craziness that we had before. There's still plenty of people, and I don't enjoy the fact that many restaurants are closed, and you can't do the cultural things you used to do. But the fact that a lot of the tourists are gone, and that the craziness has been sapped out of the city, I think that's not necessarily a bad thing. And a lot of locals, I think, agree with that. Now the beaches are for locals, and it's really fun, to go down there instead of having them crowded with tourists, and so you have that aspect. But I foresee that there's a major, when we get the population numbers next year, I think that will show a major outflow of people living in San Francisco.
There's got to be some budgetary impacts of that. When do you think those really begin to show up in a biting sort of a way?
I mean, that budget fiasco is just a nightmare. And whether it's San Francisco with its $12 billion budget, or the state of California, right now they're just juggling all these balls, trying to keep them in the air. And at this point, the stock market hasn't crashed yet. I mean, the budgets are very dependent on capital gains taxes. So when that happens, it's a complete utter nightmare. It's already a nightmare. So this is a problem administrations will have to, and not just here in California, but this is in Texas and elsewhere too. State and local budgets are in really bad shape. Yeah,
that's got to start biting soon, though, I would think. I just heard that
talking about pay cuts for city employees in San Francisco already. That can happen if a financial emergency is declared. At some point, we're going to see layoffs among city employees. And during the financial crisis, when that extended the recession and the employment crisis, when the local government finally decided to lay off people and in large numbers because they didn't have the money. That doesn't happen right up front. It's a slow process, and then eventually it does happen, and it extends the unemployment crisis. Yeah, we'll see that probably, unless we instantly bounce back over the next 2 or 3 days, and everything. I think we'll see that playing out.
Yeah, I just heard that Nashville, if I heard it right, just raised their property taxes by 37%.
Oh,
I mean, it was a low tax sort of a district to start with,
yeah.
but and then when talking with Mish, it took him 3 weeks to get a U-Haul truck that was going to be able to leave from Chicago. So he's one of many people sort of fleeing that area because for all sorts of reasons, but not least of which is that place was a financial basket case before any of this happened. But now that they're having that flight from the city for all sorts of reasons, some of them for safety reasons, security reasons, people just woke up and said, I don't want to live in a place that's this financially ruined and desolate, all of those. So what are they going to do? They're going to have to raise taxes on the remaining people. And so you're going to see that. It feels like what cities went through in the early 90s to me, when they got caught in these spirals where the more people left, the more people had reasons to want to leave. It just takes time to sort of reverse that process and get things going back the other way. So I think we're at the beginning of a lot of pain for a lot of cities, which are loaded with expenses. Really $12 billion budget for one city? That's amazing.
And San Francisco isn't a big city. You're talking about 860,000 people. So it's not like a 4 million city, it's a relatively small city. And, a lot of that comes from tourists. So the tourists are not showing up. And then there's, local sales taxes and different things. And property taxes are relatively low in California, especially for people, only for people who've owned their homes for a long time, But, that's going to show up on the ballot. So raising taxes, cutting expenses, I mean, those are the two options they have. And, and they raised sales taxes during the financial crisis. That's another option, but, it is really not a lot of ways to deal with it. I mean, you cut your expenses or you raise taxes or both. And or you borrow, but city and state governments are limited in how much they can fund their deficit. So, essentially it comes down to that.
Well, maybe you could find a way to issue bonds that would go into the J&K fund, which the Fed is buying. Just issue some bonds that you promise never, ever to pay back, and the Fed might buy them from you. You never know. It's crazy. So are you personally having any thoughts of moving?
No, like I mentioned the other day on my website, we're not even thinking about leaving.
Yeah.
To channel power a little bit. We love it here. So it's a great place for us to be. So I work from home. My wife goes to the office in the Valley and working for a non-tech company, and we have no reason to leave.
So do you think, will stocks ever go back down in price?
Well, I have my money on it. That's not been a very successful bet so far, but when we have these periods of utter euphoria where people question the possibility that stocks will ever go down, we're usually not far from the next sell-off.
Yeah.
And we had that last February, we had it before where you see all these commenters and saying this is going to go on forever. And you get to that point and you're pretty close to the next sell-off when that happens.
I know it's just painful for people like myself who watch it in what appears to be super slow motion. I'm sure other people would be caught flat-footed, but I feel like we must be close because I watched this thing the other day of these two guys who are basically speaking in bro surfer talk, talking about all their can't lose trades and how they're just levering up, and risk is, being cautious is for fools and all that stuff. So there's a lot of that going on.
We've heard that before, right?
Yep, yep. So uh, I have to say though, I'm really mad at the Federal Reserve for doing this again. Like they should know better. They know what the pain, they know what the downside is. They didn't have to do this. There was no reason for them to go this crazy, but they did, and I think they know better, and they're not dummies. So I really am not in a very generous mood to spot them any credit and say they're trying their best in a difficult situation. I think when this blows up, I think accountability ought to land on them this time. I really do.
Yeah, yeah, and the interesting thing is in the financial stability reports before the crisis, that kept pointing out corporate debt as being one of the big issue. There's too much corporate debt, and so now we get the sell-off. And had I allowed these companies to file for bankruptcy and clear out those debts in bankruptcy court, that corporate debt problem would have been solved. But they're not doing that, so now they're bailing out the credit market. So now corporate debt is a much bigger problem than it was a year ago. And the companies are selling less, and they have more debt, and a lot more debt, because they've raised all this money by selling bonds. And so now we've got a much bigger problem than we had before. And at the same time, our economy isn't functioning well anymore. So they should have allowed a few months of roughness in the markets and for the debt to be dealt with in bankruptcy court. And so, yeah, the creditors will get the company, will get the equity, and the equity holders will get the bag. And some creditors will get very little, and other creditors will be made whole. And this goes through the procedure of a bankruptcy filing. And we would have emerged, the economy would have emerged with a lot less corporate debt. And I fault the Fed for failing to use this opportunity to solve what was the biggest problem it itself acknowledged the economy had. And they just didn't have the balls to do it. And they should have said, we'll fund the federal government. Yeah, we're not going to have a debt crisis in the United States, and that's it. And companies are on their own, and they should have encouraged the federal court system to hire 20,000 bankruptcy judges to get this done faster and create a lot of jobs that way and move on. And that didn't happen. And so now we're stuck with another crisis that we emerge from with way too much debt.
Like the drunk who's in the ditch with her car. I think the Fed took a couple more nips off the bottle, because if they were really worried about corporate debt, they wouldn't have been like, this corporate debt looks a little high, so I'll tell you what, we're going to buy some directly. Only from the big ones, though. That's the way to solve it. Buy bonds directly from Apple, Microsoft, and Coke and stuff like that. It's yeah.
The fact that corporations can borrow money below the rate of inflation is something that, I mean, we've seen that happen in Europe for years now, but it's now here in the United States too. And especially at a time when the Fed is allowing inflation to perk up, and without stepping out. I mean, that's an issue that I think is very bad. That is encouraging companies to borrow like maniacs, and consumers too. I mean, but it's really with companies borrowing below the cost of inflation. That is a very bad dynamic, and that takes all the discipline out of the capitalist system. There's a negative cost of money, of capital. So it's the more you borrow, the better off you are, and even if it just destroys how investment decisions are being made, and that's terrible.
How do you protect yourself? I mean, are you just sitting on cash waiting, or? got a little shorts.
I
But
I do some of that. You know, I think there's going to be some opportunities, and I want to be ready for it. So I do that. Um, yeah, it's very difficult. I don't see a lot of good investment opportunities. You know, I'm retirement age, and I love having my own company and working full time and more than full time, and being busy and doing an incredibly fun thing. And that's, yeah, I love that. And so I'm not worried about having to live off whatever, you know, for another 30 or 40 years, or however many, 3 years, however many I got left. And so I think that's the big thing in life today. Uh, if you have something fun to do that makes you money, when you're quote unquote retirement age, that's, yeah, that's really what you need to do. That's how I look at it, you know. And whatever money you have and the income you make on the side, you know, that's great to have, and but it's not a requirement. So that's how I look at it, and I'm not really too worried, because I'm going to do this until my brain freezes over. It's how I'm doing it, and it's making some money, and I'm happy with that, and that's my plan, you know, and the rest of it is just play money for me.
Yep. Yeah, I don't. My biggest investments are in soil and animals right now, because I'm doing the whole mini farm thing, and I'm investing in my community, and we've got a really fun project here that I think is going to really could occupy me for the rest of my life, you know, because we're going to create a place where people will come and have experiences that more directly relate to nature, and maybe learning how to make a fire if nobody's ever done that before, or learning how to plant seeds, or just having time in nature, or anything like that. But yeah, I don't know what else to do. I can't participate in the regular culture anymore. I don't do left, right. None of that really intrigues me very much. I see them as both being played. I think there's forces in the media that are very good at pulling people's emotional strings. I see it happening on a daily basis. I see former friends become fractured around I see people not enjoying their lives. The more people participate in the manufactured world of whatever the media is putting up, I see the less that they are actually enjoying themselves. And so I am increasingly uninterested in that for myself, as a way of entertaining myself. So it's kind of how I've been rolling with this.
Yeah. Oh, that's great. I mean, if you have an activity that you enjoy doing, like you have your property out there and you're building something, you know, I mean, that's fantastic. That's really that's wonderful. And if the S hits the fan somewhere in Washington or somewhere else, you know, you still have your thing, and you still enjoy life, and still have your friends, and you know, that's how I look at it. But the enjoyment of life is really what matters the most. And if you know, if you enjoy, if you do what you like doing, what you have a passion for, then I think you got it made.
Yeah. No, lots to be grateful for around that. And I know a bunch of people who are pilots or were pilots. I mean, nobody knows if that's coming back for a whole giant percentage of them. Things like that. So yeah, very fortunate to be where I am in life right now. And yeah, I wish everybody could sort of find that passion and find their place and do what they really love. And I think that's a big part of what's happening post COVID, is people woke up and said, I really didn't like I didn't like my life before, you know? And I think that's a good time to take stock and become more entrepreneurial and figure out what you're good at, what you really like to do, and then putting your efforts there rather than participating in earning a paycheck from some job you hate, you know?
Yeah.
So.
Yeah, there may be some good things coming out of this pandemic after all. I agree. And as people are looking at companies too, everybody's looking at things now, how to do it differently. And some of those changes may take us out of a rut and get us into a better direction. I think that's one of the, if you look for the silver lining, I think that's one of the ones you might be able to find.
Well, I hear, you know, guaranteed. So we saw in Hong Kong, this February and early March, their flu season was crushed because everybody was wearing masks and social distancing. I bet the prediction here is our flu season is going to be crushed, and that's a good thing. I was trained in microbiology and I had to do all this stuff with diseases and stuff, Wolf. So I was the guy who was never happy. I'd be on a plane and some guy would walk in dripping snot, red eyes, kind of coughing loosely into his, like not into his elbow, like coughing on his wrist, like that was going to help, and I'd be that guy just holding my breath as he walked by, hoping that was sufficient, So I think we're done with that. And I'm glad for that new awareness of public health that I think can come out of this. Cause why spend all that time, sick if you don't have to be sick? And so we know stuff about that now. And people understand that if we have vitamin D in our systems, that can help boost the immune. In fact, maybe we should eat better. I think there's a lot of good things that come out of this.
Yeah.
Honestly. So I hope.
We can always hope. Yeah.
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 I guess I'm glad I don't live in Florida and some other places which seem to be having trouble with some of the basic ideas here, at least at the state level. So, all right. Well, with that, thanks so much for your time today. And of course, people can find you at your website and all your great writing there. And by the way, your other contributors just doing a really great job.
Thank you. Yeah. So for everybody who hasn't heard, wolfstreet.com, no politics, just business, finance, and money, as I say in my podcast.
Yeah, and good comments. You got a good comment crew showing up there. So nice job moderating that too, by the way.
Yeah, I just interestingly posted an article asking landlords among my readers to respond to the CDC eviction moratorium and to really what their rental payment situation is. And because I couldn't match the data we get from the household surveys of people not making their rent payments to the data where the landlords say so many percent of rents are late. And the household surveys paint this gloomy, dismal picture of a third of the people not paying their rent or whatever. And the landlords are saying this, so this is 11 million units owned by landlords, where they're saying, yeah, it's only 1.9 percentage points worse than it was last year. And so we can't put these two together. So I described that situation in my article and asked the landlords to comment and give their story, give their payment situation on rents. And almost all of them say, so far everybody's been paying. Almost everybody's been paying. It's not worse than last year, or it's not much worse than last year. We will always have issues. And so there's a lot of comments now from landlords on that article, and it's really interesting to read. And little landlords, have 2 or 3 units, and big ones that have a couple of hundred, bigger ones, a couple of hundred units, apartment buildings, that kind of thing. And that's the kind of comment section I like to have, where you actually can learn something from commenters. Yeah.
Oh, fantastic. Hey, check it out. We've got I just recorded it today. It'll be out sometime, I guess this weekend, probably, maybe Friday, with Ken McElroy. His firm runs about 10,000 doors. They've got about $1 billion under management. And he cut his teeth in property management. So he worked all the way up and knows it cold. And he was describing a lot of the dynamics that they're seeing, but it wasn't a third of their people are not paying. But they pick very, very carefully which markets and all of that. And he knows people who are getting kind of hurt right now. So it's real estate. That's not an asset class. It's many, many, many individual asset classes. So yeah, you might be interested in that one. Good guy. Knows a lot.
But if you're in student housing, you're in trouble.
Yeah, and if you're in places where there used to be a lot of pilots, for instance, or things like that, but and as well, he said there's great data. He said if you ever want to know what's happening in real estate, just pull up the U-Haul data and see where people are leaving and where they're going to. That describes most of what you'd be experiencing. So that's always fun to check out. I haven't done that in a little while, so I should go check that out. All right, wolfstreet.com. Check it out. Great stuff there. Wolf, thanks a lot.
Thank you, Chris.